Thanks so much for joining us to be able to go over the coronavirus, COVID-19, and a look at your financial risk. We've been getting a lot of questions right now as far as this is the first time people are starting to see how their portfolios really react to market risk. If you're not a client with us, this is something that maybe you've never been through with your advisor and you have concerns about it. So let's get started so that we can go over this a little bit further. Before we do, though, make the lawyers happy. All the information that we're covering is going to be generalized. I don't know you. You don't know me per se. We want to make sure that the advice we're giving is sound. So at the end of today, you're going to have an opportunity to take advantage of a complimentary conversation, 25 minutes to check in and see what's going on in your world and where we can best help with those questions. We're all here because, among other things that obviously have us concerned, we're nervous about the markets. So I'd like to spend the next 25 minutes together giving you some key insights, some concrete questions you can ask yourself, and some practical action steps you can be taking to increase your financial certainty. Because whether you're sitting in front of the TV, computer, or scrolling through your phone, uncertainty seems to rule the day right now. On Monday, March 9th, that marked the beginning of the stock market crash of 2020, with the history's largest point plunge in Dow Jones to date. That day was followed by two more huge drops on March 12th and 16th. And so far, we've seen the three worst single-day point drops in U.S. history. Over just a few weeks, the markets have dropped anywhere from 25 to 30%. And the question everybody's asking is, should I stay or should I go? In other words, should I ride this thing out as many advisors have traditionally recommended, or do I stand to lose a ton more waiting for things to bounce back? If that's you, if you're wondering what to do, I want to let you know that at the conclusion of this, you're going to have that opportunity to set up that conversation, a virtual meeting with their firm. You don't have to be here in person. A lot of you guys are on lockdown, and I highly encourage you to do that. We've been flooded with individuals calling for advice. Maybe they have been doing it themselves up to this point, or maybe they've been working with an advisor that maybe has not been experienced with what to do in the case of market downturns. Maybe they didn't feel like they were protected in the right way. We'd be happy to assess your particular situation, talk you through the options, and help you get a plan in place to protect yourself no matter what happens in the market. So be sure, take advantage of that opportunity as we wrap up. It's no wonder you're concerned about the market. If you ask 5 people right now what the market's going to do, you're going to get 5 different answers, because the truth is no one really knows what's going to happen. Frankly, anybody that's telling you that they can predict what's going to happen, you got to be a little suspicious of it, right? We're in uncharted waters here. There's never been a global pandemic impacting global markets like we're experiencing today, and no one can predict where things are going to go from here. So with so much information flying at you at once, how do you even make sense of it all? And nobody's got that crystal ball. What indicators should you even be looking at to help make you have informed decisions? There actually are some key indicators that we can keep in front of us that help put things into perspective. So let's look at those. Here's the 5 things that we want to consider with your financial future and the level of risk that you're willing to take. First, what's the speed in which the markets have dropped? Potential for market to drop even further? Skyrocketing unemployment numbers we continue to hear about. The overall impact this pandemic is going to have on several key industries in the economy overall. And finally, the rate at which this virus continues to spread. So if we break it down, let's look at those individually. The first thing we can take a look at is the speed with which the markets recently declined. It only took the S&P 500 22 trading days to fall 30% from its record high. And that high was only back on February 19th. It makes it the fastest drop of this magnitude in history. If we look at this, obviously everybody's loving charts and graphs right now, right? But we have to look back at history. Bank of America securities, we look and see that the second, the third, and the fourth quickest 30% drops on Wall Street all occurred during the Great Depression era. It was 1934, 31, and 29. In other words, nothing like this has ever happened. But the closest thing to it was nearly a century ago, and it was the worst economic downturn in our country's history. And the market crashed in October of 29. By July of 1932, it was down 89% from its previous record high. So as you think about your retirement savings, it becomes critical to consider a second fact. How much further could the markets continue to drop? Having seen roughly 30% drop so far and knowing we don't have the virus even remotely controlled yet, it's fair to at least acknowledge that the market could still drop considerably more. In fact, in a March 23rd article that was in Forbes, senior contributor Chuck Jones indicated it was very plausible that the markets could drop another 20 or even 40%. Again, none of us know what the market's going to do, but hypothetically speaking, if it did drop another just 20%, bringing that total decline to 50%, let's look at what it would take to recover. One of the many things people misunderstand is the amount of gain that it requires to recover from a loss. Mathematically speaking, losses hurt way more than gains. As parents, you say, man, if I have to do something and reprimand my child, it's going to hurt them worse than me. Well, those declines are going to hurt you worse than the gains do. As an example, if you had $1 million in the market and you lost 50%, you're down to $500,000, right? $500,000. And many people simply think, well, if I had a 50% loss, I obviously need a 50% gain, and I'll be back to where I started. Unfortunately, that's not how math works. This is one of the most commonly misunderstood things about the market. You see, here again, if you're 500,000 that you had left after a 50% loss, and then you got a 50% gain back in the market, how much do you have? You only are back to $750,000, well short of where you began. In reality, in order to recover from that 50% loss, you actually need a 100% gain. And how likely is that to happen in this market? Better yet, how long would that potentially take? During the Great Depression, when the S&P 500 dropped 89%, it took it over 25 years to return to its previous high. So while we don't mean to be alarmist, if you were to experience anything even remotely similar, you really have to ask yourself, do I have the time necessary to even see the markets climb back up? For somebody 60 or 70 years old, they simply may not have that many years ahead of them to wait before they're pulling from these accounts. Several of you probably recognize this person. It's Uncle Warren, right? Warren Buffett, one of the most famous investors alive and currently the fourth wealthiest individual in the world. He's known for his market savvy. Buffett's amassed a net worth of $70.5 billion. So what does he have to say about incurring market losses? Well, he's long been quoted as saying there's two primary investment rules. Number one, never lose money. And number two, don't forget number one. Why does he say that? Because as we just saw, losses hurt more than gains help. And it takes a lot to recover from a significant loss. Buffett's always understood that if you want to make money, you start by not losing what you already have. He also recently said it's insane to risk what you have for something you don't need. In other words, the fourth wealthiest man on this planet is not a big fan of taking on excess risk, particularly when it's not required to reach your end goal. So what does that really mean to you? You're not the fourth richest person in the world, right? It means if you can live the life you've desired in retirement right now without having to take significant market risk to hopefully accumulate more, you likely should. For many who have had a good run in the market over the past decade, if staying in right now to hopefully pick up some gains if the market recovers, that would be nice, but it's not necessary. The added risk just doesn't make much sense. So having looked at the speed of the market dropping and how much further it could potentially go, let's look at our third factor to consider. The third indicator is the alarming rate of unemployment that's being caused by the virtual shutdown of our nation. It's a record-breaking 3.3 million Americans applied for unemployment in the week of March 21st. Just that week alone. The previous record in this country, just under 700,000 claims. So you can see on this graph, it's showing you back into history. When was the biggest spike with that? And then you see this nice sharp line at the very end as 2020. It's not the end of the graph. Guys, that's how much it jumped up by. It's unseen. It's unseen before. Forecasts for unemployment in April alone range from somewhere between 500,000 to 5 million more Americans without jobs. In fact, weekly unemployment claim numbers are climbing so rapidly, the White House has actually asked state officials to delay releasing the precise counts. Economists for the Federal Reserve project that total unemployment that could reach 32.1%. That's 47 million Americans. Let's put that into context. That's the equivalent to all the residents in New York, Florida, and Colorado combined. So unemployment doesn't look good, right? What about the global economy? Well, our fourth variable here is the impact this outbreak is having on major industries and the economy worldwide. The retail industry, which is normally responsible for contributing 2.6 trillion or 25% to the annual gross domestic product, that's nearly ground to a halt with stores closing. I know around me just alone, you see all the hospitality that's closed. You drive down International Drive in Orlando, you see restaurants, hotels, businesses all closed right now with signs saying we're closed until otherwise noted. We don't know when this is going to come back, right? All told, estimates suggest that the coronavirus could easily cost the global economy over $2.7 trillion. What does that all really mean? Those are huge numbers, right? You're talking a 2 and a 7 with 11 zeros behind it. These are unheard of numbers. We just can't, maybe Monopoly money, right? You've played with that, but it's very different. Well, the first, it virtually guarantees, as far as the meaning with that, virtually guarantees continued market volatility for months. It's for months to come. Second, it means additional economic stimulus will likely be required by the government, which could lead to higher taxes in the future. We're all going to have to repay these funds that are being used. They're talking about doing a phase 4 stimulus with this to help. We've already had 1, 2, and 3. We need to do more in order to continue to kickstart our economy as we come out of this. But all of this could obviously greatly be improved if we just stem the tide of the coronavirus, right? That's all we got to do. That's everybody. We started with 15 days to do our part. Now we're to 30 days to do our part. Stay home, stay inside, shelter in place. Well, let's take a look at how that's going. U.S. now has the highest number of known coronavirus cases in the world. We quickly surpassed China and Italy. Some say it's because of our testing and what we're able to do. Those numbers, by many accounts, they're very conservative, right? People in many states, they're still struggling to be checked for it because there's a shortfall in testing. So even though our testing is better than elsewhere in the world, there's a shortfall on the testing. And there's studies that predict that the gaps in healthcare resources, that if those aren't filled, there's more than 80,000 Americans that could die by July from this. To put that in perspective, let's look at the counts of the U.S. from recent outbreaks like SARS and H1N1. SARS claimed 774 lives worldwide, but none in the U.S. H1N1 in 2009 killed 12,469 in the U.S. This, so far, it's anticipated to be 6.5 times worse than what we experienced with H1N1. With all of these things considered, and so much feeling completely unpredictable right now, what can we predict? What can we be sure of as it relates to your financial future? The reality is that the only thing certain right now is uncertainty. And while we'd all like to know when this pandemic will end and when everything's going to return to normal, the truth is we likely need to be planning for the worst and we hope for the best. What does that mean tactically to you right now about your retirement savings? That's what you care about, right? You don't care about what might happen. You care about your individual account and how it's reacting. Well, there's obviously hundreds of things that you can do with your money, but for the sake of today, we're only going to cover 3. The first option you have, you leave your money invested. You simply leave it alone. I can remember as a kid, the Showtime rotisserie oven, set it and forget it. That's what a lot of people say with this, right? You've heard people say, just ride it out, weather the storm, you'll be okay, it always comes back. And for decades, that's what people have told their clients. You don't time the market, but leave the money in for the long haul. The problem, as we've talked about, is there's no current assurance of where the bottom of this present decline is going to be and when we're going to see any noteworthy recovery. Again, if the market was to drop another 20 or 40% on top of the 30% it's already fallen, you could find yourself 60% down from where you started. That means if you started with $1 million at the beginning of this year, March 8th, you roll into this and all of a sudden now it's only worth $400,000. Most people just aren't interested in that kind of risk. Option number 2, you simply sell it off. You cash out. You say, I'm cashing in my chips. I'm done. I don't want to play this game anymore. For many people who've been invested over the past decade, you're still actually sitting on some pretty solid gains over that stretch. You could simply want to go to cash and sit completely on the sidelines. And while this whole thing's playing out, you sit there and you say, I'm done. And obviously, you're earning nothing on your money during that time, but you might subscribe to the old saying that a bird in the hand is worth two in the bush. However, knowing at some point in the future, hopefully sooner rather than later, this outbreak's going to end and the economy's going to recover, do you really want to miss out on all the potential gains of riding the market back up? Many people aren't interested in that option either. So what if you don't want to go to cash, you don't want to just stay invested in the market, those things don't have an appeal to you. It's a unique situation, right? Everybody's situation individually is unique, and it calls for custom tailored solutions. I can tell you one benefit a lot of people are looking to right now, and that can be found in option number 3. So what is it? A powerful third option. For those that don't want to ride things out and they don't want to just go to cash, they might use the benefits of a fixed indexed annuity, or an FIA, sometimes you hear it called. Those indexed annuities, they're retirement savings vehicles that provide complete principal protection, meaning the money you put in them can never be lost to market downturns. They also give you the opportunity for growth. So just like a traditional fixed annuity, the indexed annuity, it's an insurance product. It's intended to be used either for retirement income purposes or protected growth. However, unlike normal fixed annuities, an index annuity gets its name because it ties its annual growth to a market index, like the S&P 500, the Russell 2000, something like that, rather than offering a set or fixed interest rate. So those indexed annuities, the credits, follow the performance of the market to which it's tied. Because the principal is actually protected, should the market index go down in a given year, your balance remains flat, unscathed for that year. You simply receive zero interest. Should the market index rise, you're going to get to participate in a portion of those earnings. Now, you can't have your cake and eat it too, so an index annuity is not going to provide you all the earnings of a rising market. Now, for a lot of people, they say, Andy, that's the A word. I don't like annuities. Annuities don't make sense. Let's look at it this way. If you were to sit down right now at a blackjack table in a casino, you're sitting down, you're getting comfortable. The person's coming around with the tray full of drinks. They're making sure that you're comfortable. And the dealer says, okay, all right, here's the deal at my table. If you lose a hand, I just shuffle the deck and redeal. No chips lost. But if you win a hand, I get to keep 50% of the take. If a dealer told you that, how long are you going to sit at the table? I mean, who wouldn't sit there all day, right? Because while you're not promised the moon, remember, the dealer's keeping half of your earnings. You're promised to never lose a dime. In other words, it's all upside possibility with no downside risk. This is very much like how that indexed annuity works. And let me tell you, right now, people with money in those indexed annuities, they're most likely doing cartwheels. Because while they didn't get all the up last year in 2019, 2020, with everything that we've seen, they're still sitting on the exact same amount, unaffected. So their neighbors, their coworkers, their accounts that are otherwise not protected with that, they might be down 30% or more. But the account balances in those index products are simply flat. They're not losing a cent. So if you're wondering, is this even right for me? Simply ask yourself this question. Which would I rather miss out on? Which is going to cause me more lost sleep when I'm staring at the ceiling at 2 o'clock in the morning? Would I rather miss out on capturing every cent of the eventual market recovery when this whole thing ends? Or would I rather miss out on losing another 20 or 40%? If you're okay with missing out on some of the future recovery, but you cannot stand the thought of more loss, it's probably time that we hop on the phone and see what's right for you. Guys, these can be done wrong. If you do them incorrectly, you can wind up in a position where you don't have enough cash on hand for basic necessities. You're going to run into issues down the road. So these need to be designed by a qualified professional that has experience in working with people as they're spending their money down, not just growing it. None of us know what lays ahead. But the chief investment officer of Guggenheim Investments just said this in his recent outlook. I'm not betting on a global depression, but I'm saying that for the first time in the post-war era, we are really getting too close for comfort. So when the chief investment officer of a global investment firm managing over $270 billion says something like this, you want to listen. road ahead is likely going to be bumpy. And while tons of things right now are out of your control, your financial future actually isn't one of them. That fortunately is something we can help you with. In the midst of these crazy times, it's important that you just have a plan. Got to have a plan. It's more than having just a portfolio. That plan is necessary to be your guiding principle that you can always call back to and know why you're spending from what account, when, how much, and everything else that falls suit with it. Getting started, that's simple as can be. Businesses all over the country might be shut down. Ours is 100% open, both in person and virtually. And a visit with us is as simple as an initial 25-minute phone call, just a virtual meeting where we can chat with you on the computer. You just click the link that's below. You can choose your desired time. Just simply fill out the form and tell us the top 3 times that you've got that work in your schedule, and we'll coordinate so that we can make sure that a time works for you. It's that easy. Oh, and here's what the visit's not going to be. It's not going to be a member of our team sitting on the other end of the line and they're just pitching you some product or solution, telling you to go grab the checkbook. No, instead, it's us getting to know you, asking some key questions and listening to your concerns. So we can conduct a risk exposure analysis showing you exactly how much of your assets are currently exposed to further risk. And if you're interested, we can make recommendations as to which next steps would benefit you the most. I'll start simply with telling us a time that's going to work for us to connect. That's it. Just finding a time to chat. If nothing else, we're going to be friends and part that way. At best, we help you out with trying to find solutions that are going to last for your lifetime. I want to leave you with one more quote from our friend, Warren. He's famous for having said, when it comes to the market, you never know who's swimming naked until the tide goes out. In other words, many people don't realize just how exposed they are on Wall Street until the market crashes. The good news is you can do something about any further losses, starting right now. So click the link so that you can choose a time for us to connect. You'll immediately receive a confirmation email from Susan or Sierra letting you know you're all set. Then, in the meantime, grab a cup of coffee, pour a tea, take a deep breath, enjoy the little things around you. It's going to be okay, and we look forward to talking to you soon. I appreciate your time today. Again, you can connect with us at 407-299-4129 or visit us online at thelifewealthgroup.com. Thanks from us to you.